Hey guys, it's Marko Glisic with GreenGrowth CPAs. Thanks for joining the webinar. If you have any questions, please visit our website at www.greengrowthcpas.com.
Hey Eric, how's it going? Thank you for coming for the Fiona My event. It was exciting event. I mean, we're really excited to host Fiona. I think the showing was pretty good too. Hopefully you guys kind of got some info and that was helpful. We have Nikki. Hey Nikki.
Hey guys, it's Marko Glisic with GreenGrowth CPAs, and we're back with part 3 of a 3-part valuation series. And before we get started, I just want to let you guys know the information contained in this webinar presentation is meant for guidance purposes only and not as professional legal or tax advice. Further, it does not give personalized legal, tax, investment, or any business advice in general. And now that we have that out of the way, let's get started. As far as the agenda for today, we're going to do a quick recap of the previous webinar. We're going to revisit the discounted cash flow model because, again, I think it's a very, very important topic. And then we're going to dive more into manufacturing, distro, and ancillary business valuation. And so what I'm going to talk about when I say distro businesses, really what I mean is kind of the businesses that are taking the product either from cultivators to manufacturers, right? They're taking the flower, the trim, right? The biomass for the further processing, or they're taking the product from manufacturers to retailers, right? They're taking it to dispensaries and delivery services. And I'm really not talking about the delivery guys that kind of go to your house, right? And when you talk about manufacturing businesses, some of the examples are, right, like the edibles company, right, or the company, right, that makes chocolate infused THC, right, or CBD infused THC, right, gummy bears, different type of concentrates, oils, tinctures, that type of stuff. But first, a little bit about us. So we started off as a tax preparation shop. We've completed over 500 annual tax returns for cannabis operators across all verticals, right, so dispensaries, distribution, cultivation, manufacturing, delivery, and testing. We have over 300 clients based in Colorado, California, Michigan, Oregon, and Washington. We've performed over a dozen auto-related projects in the last year, and we expect to hit 7 digits in revenues in our full second business year. We really have a thorough and deep understanding of tax compliance and insurance-related matters for cannabis industry. I mean, we really do bring a deep bench of CPAs and CFAs. But first, let's quickly kind of do a recap of the previous webinar. So we really kind of covered the valuations for cannabis, cultivation, and retailers. We understood the key assumptions driving the business valuations, the importance of doing your due diligence, right, by looking at point of sale systems, payroll systems, accounting software, and really kind of by going there and visiting the operation, right, kind of seeing the buildings, seeing the cultivation, seeing how their dispensary operation works. Again, another important concept, bad companies can be turned around, and very often there's some great gems sitting there. And lastly, making sure that your potential target is compliant, right, when it comes to taxes, licensing, and other compliance matters. All right, guys, so let's get started with the DCF model. I know we hit on it before, and the reason I really want to stress it is because I really believe it's very, very important. It really is the best way to value cannabis businesses. And as we kind of start diving into business assumptions for manufacturing distro companies, I kind of want you guys to see the big picture, kind of how it all fits together, right? So if we look at our DCF model, you can really kind of break it out in 2 parts, right? We have our business assumptions and we have our valuation assumptions, right? So everything in the top highlighted blue is our business assumptions, and everything in the bottom highlighted pink are valuation assumptions. And valuation assumptions, it's really kind of the stuff that comes from the finance theory and modeling, right? And it's really just a matter of kind of really having a deep understanding of finance, how do you develop the discount rate? What's the proper math and calculation for those? And those things don't really change. The methodology and calculations doesn't really change as you're kind of moving from cultivation to retail to manufacturing to distribution. Now, as far as the business assumptions, that's something that's really unique, right? It's really going to vary by different verticals. But again, it can be summarized by, hey, what are the sales? What are the earnings, right? What is the EBITDA? also known as earnings before income tax, depreciation, amortization. What are those amounts, right? Because those amounts really kind of tell you what's the cash flow, kind of what's the cash that stays with you, the investor. And kind of once you have that info, then you can really kind of complete the model. And again, as we previously mentioned, kind of the higher the cash flows, right, the more the value the business has. Now, as far as the business assumptions for manufacturing, distro, and ancillary businesses, they're going to be very similar because, again, these are similar type of businesses. Again, as you break it out, it's really business to business. It's kind of wholesale distribution model, salespeople, boots on the ground. So again, those businesses are going to be very similar, which is kind of the reason why we're putting them in one presentation. Obviously, there's going to be some uniqueness, but for the most part, it's going to be very, very similar. All right, so let's kind of take a look how projections and business assumptions look for like manufacturing distro operation, right? So at the top, we have our revenues, right? Which revenues, it's really just how much we have sold of product for a certain time period, right? Whether it's a day, a month, or a year. From there, then we're backing out all the expenses, right? And kind of the first expenses that come up are really the cost of production, right? Or also known as cost of goods sold, or just more simply COGS, right? So things you kind of tend to see there, right? It's like the raw materials, the labor, the packaging, and all these costs, they are kind of what's called variable costs. The more you produce, the higher those costs are going to be. It's kind of going to scale with your revenues, right? If your revenues go from 2 million to 5 million, your raw materials, your labor, your packaging costs are going to go up, right? So they're variable, right? They kind of scale with revenues, higher costs. Once you kind of subtract those cost of goods sold from revenues, what you get is your gross margin, right? And that's a good indication how healthy an operation is, how much it's getting that kind of top line profitability. From there, we're kind of going into the other expenses, which are called below the line, right? So we're talking about selling, marketing, distribution, overhead. Some of these are going to, again, be variable. Some of these are going to be fixed, right? So if we're looking at selling expenses, again, if you want to go from 5 million revenues to 10 million, you're probably going to need more salespeople, right? You're probably going to have to spend more on marketing. And that's the reason why these costs are also variable costs. Kind of more fixed type of costs, we're talking about rent, utilities, accounting, legal costs. These are fixed, right? So whether you're doing 5 or 10 million in revenues, for the most part, they're going to be pretty similar, right? And so kind of as that revenue scales, those are kind of staying the same. And once you back that out, really what you're getting is your operating income and EBITDA. And this is a really good indicator of kind of what's the cash flow, right? Kind of, hey, this is how much we have sold. This is kind of all the things we've spent our money on. So materials, labor, packaging, rent, salespeople, marketing people, right? And this is kind of what the take home is, right? That we can then take and reinvest back into business, or we can distribute to the owners. And so then what I want you guys kind of to see is then how does this EBITDA and all these business assumptions, again, feed back into that DCF model, right? So we're going to revisit the DCF slide again for the 15th time, but again, it's important. But I want you guys to see right here in the top, we have those business assumptions, and here's our EBITDA, which is really kind of the main driver of the cash flows. So again, as long as those business assumptions and the projections shake out and they're good, we can really get to a good indication of value and kind of, hey, how much I should pay for this business. And so again, I think that's really kind of what I want you guys to grasp. So now let's tackle each financial statement line item in those business assumptions, right? So let's first start off with revenues, right? With the top line. And so there's really kind of two ways to take a look at it. One is from bottom up and the other way is from top down, right? So if we're looking, and both are useful and very important, right? So if we're looking for bottom up, really what we're looking at is we're kind of trying to get a sense of the capacity, right, of the machinery and equipment. This piece of equipment that this business has that I'm looking to invest, how many units can it really produce, right? If we're running this machine at a maximum capacity, we're just banging out product day in, day out, just constant production runs, and we can sell that product, really like how many units can that produce, right? And now if I take those units produced times the price of selling them, it's going to give me an indication of kind of the revenues, right? So that number can be, hey, this machine can produce 1 million units a year, and if we multiply that by 30, we get 30 million, right? And why this is important is it kind of puts the brake on the projections, right? So if you're looking at projections and the capacity is 30 million, but they're projecting 60 million, hey, that's a big gap. Let's look into this. What is going on, right? And then that's going to also tell you, hey, do we need to invest some additional money to kind of keep scaling this business, right? If they're already at capacity, well, gee, then really the only way we can scale this is if more money needs to be invested. And again, in some cases, buying this equipment, it can be pretty expensive. So it's good to know these things ahead of time. Now, as far as top down, we're kind of really more looking at how many dispensaries is business projecting to sell to, kind of what's the average size of a dispensary purchase? What's the product mix? And with product mix, you can go in a lot of detail, right? So how much of edibles are being sold versus concentrates? How many of these are branded products, our own branded products versus white label? Within that, kind of what are the different packagings? And this is very, very important information because it really kind of breaks down the operation and gives you a full understanding, right? So, for example, let's say branded versus white label. Generally, white label products have a lower margin, right? So you really want to know kind of how the distribution is taking place, right? And as far as kind of due diligence and getting comfortable with those projections, again, go back to their actuals, and where you're really going to look through and dig into is going to be their billing software, right? So every company needs to have a billing system, right? Where they generate an invoice for a dispensary that indicates, hey, we've sold you this product at this price. And that's very important. Number one, they need to have that from compliance perspective. And then number two, it's going to be a great source of data for you to really kind of understand their revenues and their top line. As far as a white label product, you have a lot of brands out there that, they have a great brand. A lot of customers love them, but they don't really want to do their own production. And so what they'll do is they'll partner up with a manufacturer, and they're going to tell them, hey, manufacturer, your job is to produce our product. Here's the recipe. Here's how to do it. And your job is to produce and distribute it, or maybe just produce it, we're going to take it and we're going to distribute it. Versus a manufacturer might have their own brand, right? Where they own this brand, they market it, and they kind of get the full benefit. And so kind of where you see with the cost structure, right? If you're running with a white label product, right? You're a manufacturer and you have a lot of white label products. In addition to all those costs, right? The cost to produce, right? The raw materials, the labor, the packaging, right? On top of that, you'll have to also pay somebody, right? For the right to produce that product. Now, from revenues, let's dive down into expenses. So first, again, let's start off with variable expenses. And number one expense there is cost of goods sold, or cost to produce. Now, with cost of goods sold, what we really, really want to drill down into is what's called unit economics. And it's a fancy word, but really what it means is how much does it cost to produce just one item of product? And you can go into a lot of detail there. It can be one product for a particular product type, right? For one edible or for one concentrate. And so really what you're looking for is, how much labor cost, how much raw materials, and how much packaging is necessary just for that one item. Now, once you know that cost, you can compare that to the selling price, and that's going to give you a gross margin by product. So now you have a pretty good sense of how well the business is doing, right? Do they have 60, 50, or 40% margin for a particular product? And again, you can go into a lot of detail with that stuff. You can see, okay, for these brands, what's the cost to produce and what's the margin? Okay, for edibles, in total, what's the cost to produce and what's margin, right? For concentrates, what's the cost to produce and what's the margin? And kind of really once you understand that gross margin and cost to produce, it's a lot easier to get comfortable with those projections. So now if revenues are going from 5 million to 10 million to 20 million, you can kind of get comfortable with kind of the projected cost because you really kind of understand what that unit cost is. How much does it cost to produce one unit? And so now you're really just kind of multiplying it with the number of products that are being produced. Now, from there, let's jump into the other expenses. These are below the gross margin expenses, and a lot of these are also variable. And so number one expense there that you see with a lot of manufacturing operations is the selling expense. And really with the selling expense, you really want to understand the breakout of it. How much it goes to the salaries of sales personnel. How does the commission structure look? How many salespeople they need and what do their metrics look like? Like one salesperson, how many dispensaries can he visit kind of per day, per month, per year? And once you really kind of understand those metrics and that cost structure, again, it's a lot easier then to get comfortable with the projections, right? Because now if the revenues are going from 5 million to 10 million, you'll know exactly what that sales cost looks like, right? Because you know how many salespeople need to be hired and how much the business has to pay for them, right? And out of that payment, how much is it going to be kind of fixed salary and how much is it going to be commission? As far as the distribution costs, again, it's also a variable cost. As sales increase, distribution costs increases. Is you want to understand what's their approach for distribution. Is it outsourced, right? Where they find a distribution company that they pay a certain percentage and those guys do all the distribution, or is it done in-house? With distribution, you always kind of want to look at it as a percentage of revenues and kind of get a sense, hey, they're spending 8%, 10%, 12%, 15%. And again, as revenues scale, you'll have a pretty good understanding how distribution costs should behave also, right? Because if it was 10% at 5 million, it's probably going to be 10% at 10 million or at 15 or 20. And then really the last variable expense that we have is the marketing expense. And this is an item that's kind of very often overlooked, but it's very important to understand the company's marketing strategy. Kind of, what are they using? Is it weed maps? Is it Instagram? Is it kind of door to door? Is it flyers? And within really understanding their marketing strategy and distribution, you also understand their marketing efficiency, right? So kind of what's their return on investment for marketing? And again, it's a fancy word, but really what it means, right? Really what we're trying to understand here is, for that company really just to get one more sale, or to get one more dispensary, how much money it needs to spend, right? In terms of those marketing expenditures. And out of all those channels, what's really the most efficient and cheapest ways to do it? Hey, if we spend $5,000 on weed maps per month, we're going to get X amount of customers coming in. When projecting revenues, this number is going to help a lot because you understand now that relationship between marketing and revenues. So if revenues are going from 15 to 25 million, how much should marketing costs go up by? You'll know whether that company is kind of getting too pessimistic or too optimistic with projections. And then after marketing expenses, all that we have is kind of more the fixed cost. Kind of the usual stuff, right? The rent, the utilities, salaries, security. And with those type of items, there's kind of two important aspects to it. One is completeness. Is the company you're acquiring, are they capturing all the costs in their projections? And we see that all the time. We'll walk into some of these due diligence deals or we'll look at some of these projections. And what we see, there's a lot of costs that they just won't report, right? And so that completeness part is very, very important. And then the second piece is really the accuracy. Are those amounts accurate? And then also another important aspect here is just kind of also understanding how those fixed costs scale with revenues. Again, they're fixed, which means kind of month to month. For the most part, they should be the same. If you're paying $5,000 for this facility to rent it out, it's probably going to be $5,000 the next month, right? But at some point, as an operation is trying to increase their revenues, if they're at full capacity, that's when their fixed costs have to rise too, right? So if out of this facility, we're already operating 100%, and we get 50 million of revenues, now to go from like 50 to 60 or 70 million, we'll probably need to open up a new facility, right? And that means that all those fixed costs will have to increase too, right? We'll have to get a new facility that we rent out, right? There's going to be more utilities associated with that. There's going to be more security costs associated with that. We'll probably have to expand our accounting team. We're probably going to have to expand our compliance team. Right, so fixed costs, even though for the most part they're fixed, it's important at what level do they kind of jump up to the higher costs, right, to the next level. And as far as the due diligence for kind of all these operating costs, right, the selling, the marketing, the fixed costs, a good way to kind of find that information and where it gets captured, it will be in the company's general ledger and accounting software, right? So their QuickBooks, their Xero, NetSuite, whatever's the software they're using. for marketing, you also want to look at their platform analytics, right? So if they're using Instagram, kind of the number of the visits per page, things like that, right? For weed maps, kind of the analytics for weed maps. And as far as the due diligence for cost of goods sold, all that information should be captured in the company's inventory costing software, where they're kind of tracking the standard cost, the variances, all that good stuff. But in some cases, when you walk into some of these companies, they won't necessarily have that system, which I guess when you acquire them, you should definitely put it in place. But a good way to kind of work around that is you can take their total cost per ledger and then divide it by the items sold, right? And that's going to give you also kind of your cost per product, but you kind of won't get the level of detail we talked about, right? You won't be able to really necessarily see branded, margin and cost versus white label, but at the same time you're gonna get some sense of really kind of how well and really how efficiently they're producing. And if they don't have that type of system in place, that's where you can kind of ask for a discount on your purchase. Hey, you guys don't really have strong controls and strong financial reporting. You're not tracking the information you need to run this business. If you want me to get in and send these things up, we require some sort of discount here in this investment. Kind of work with us. Also, some other stuff you also want to look at is their balance sheet, right? So how much cash they have on hand. Kind of what's the amount and quality of their receivables, right? How much the dispensaries owe them, right? Is it 50? Is it 70K? Is it 100K? And then you also understand the quality of those receivables. Are any of the dispensaries late on paying them those receivables, right? That's an indication of them having poor credit requirements for dispensaries, right? Because they might be making all these sales and everything is great, right? But they're just not collecting the money. And again, that's an indication of bad controls and around receivables, money collection, etc. And it's going to give you that opening to really ask for a better price, for a better deal on this investment. You also want to take a look at their inventory, how much inventory they have on hand and how much that inventory is aged. Do they really have some items in there that they haven't sold for, like 60, 90, 100 days, right? And the question is, are they going to be able to sell that product? You also want to take a look at their equipment. Again, as we're kind of going back to the revenues, you want to get a sense of what's the value of that equipment and how much it can produce, what's its capacity, right? Because then it's going to tell you, hey, if we got to scale this now from 20 to 50 million, how much money do we have to put into this operation? And lastly, you want to take a look at their liabilities, right? Like who do they owe money to? Is it the vendors? Are they up to date with their taxes? The income tax, the payroll tax? And a lot of this info, again, is going to be captured in their general ledger and accounting software. Balance sheets sometimes can be difficult to analyze, but if you kind of get the proper team that has strong accounting and finance background kind of combined with the cannabis expertise, you can get to the bottom of a lot of these things. And lastly, you also want to take a look at their controls and financial reporting, right? Kind of what's the strength of their controls around cash? What's the strength of their controls around inventory, right? Poor practices around these items are, again, indication of a company that's poorly run, and if you're going to walk into something like this, hey, it can be still worth walking into it, but you want to make sure you're getting a deal for it, and kind of these things are really going to give you the ammo to ask for that deal. Some companies, they won't really do any bank reconciliations, or they're going to wait for them for months, right? That's a really poor cash control, right? Or they're doing their cash counts, every once in a while, as opposed to doing them daily or weekly, right? They have a big difference kind of between the cash on hand versus the actual cash that gets counted. And so all these items are really then indication of poor cash controls. As far as inventory, who has access to the inventory? How often do they count the inventory? How often does that inventory turn around? All these items, again, are indication of how good or how bad their controls are. And that pretty much completes kind of the key business assumptions for manufacturing distro operations. Let's now dive a little bit pure distribution companies. Kind of above, we covered a little bit some of those different distribution models and that some stuff that goes into it. It can either be outsourced or it can be done in-house. Some companies, even though you don't see it as much, are just pure distro companies. And again, it's really just a matter of tackling them in the same way. They're really a B2B, right? Business to business operation, right? They kind of have boots on the ground. They have online marketing. And, when looking at them, you want to look at all those things we covered, right? How many people they're selling to, what's their revenue model, how many clients do they have, what kind of equipment do they have, what's the value of that equipment, what do the costs look like, things like gas, software, leases, rent, securities. So in a lot of ways, those distros are very similar to manufacturing companies. And same thing is cannabis ancillary businesses. There's a lot of different businesses, right? You have cultivation equipment sellers, you're going to have extraction equipment sellers, you're going to have dispensary displays, you're going to have labels and packaging. There's a lot of cannabis software companies out there, right? Track and trace, point of sale, security software, right? There's a lot of professional services, right? Accounting, legal, marketing, and kind of the stuff that we do, right? A lot of merchandising companies, a lot of accessory companies, right? Vape pens, bongs, cannabis butter makers, rolling paper diffusers. But again, all these companies, they're very similar in the sense that they're B2B, right? They're a business and they're selling to another business, right? So it's a wholesaling model. And again, there's some variation between them, but by and large, when you look at them and you analyze them, it's going to be a similar approach. What are their sales? What's the average selling price? How many people are they selling to? What's their cost for their service or their product? How does that look at the scale? What are their fixed costs, the rent, the utilities? And so we're not going to dive in a lot of detail in those. Kind of referring to the above slides, you kind of get a full picture of what those kind of look like too. Now, also what I want to cover is kind of a couple of different distress situations and synergies. Whenever you're looking into investment, a big part of that is just understanding the company's competitive strengths and weaknesses. So really kind of what really makes this company good at what they do, what's their strength, and also what are they poor at, where do they lack, what are my strengths, and what can I bring to the table and create a synergy, right? Kind of take my skills, my resources, and their weaknesses and create something better and really kind of increase the value of that company. And a lot of that info can be glanced from analyzing kind of the actual results and key metrics. Kind of the stuff we talked about, right? So number of products produced, sales by brand, the cost to produce, the gross margin, really kind of looking at all those financial statement line items and understanding those key metrics. And what's interesting in this industry is that there's so many distressed businesses, and really what's kind of taking place here is that you have a new industry, right? And it's composed of like a bunch of different people, right? On one end, you have a lot of this kind of cannabis fanatics, right? They've been in the industry for the longest time. They're very passionate about it. They kind of view it in between like a hobby and a business, right? And they're great people, they're the ones that have set the foundation for that industry. But now as the industry is going to the next level, this creates a lot of opportunity for really business, smart, savvy people that have great finance and business experience to jump in and really kind of turn things around and restructure it, right? And so in some of these cases, you might not necessarily need to have great cannabis experience or really, a love and passion for it. But if you have a passion for numbers, running great businesses, this is a great opportunity. These things come once in a couple of decades. So this is the right time to jump in, look at the numbers, look at his businesses, and really kind of solve that equation, look at his metrics and see, hey, how can I turn these things around and take this business to the next level? So there's kind of a couple of different scenarios we put here together. Number one, you can walk into a business, you kind of look at it, and they have terrible margins, right? It's a manufacturing company, but their margin is like 20, 25, 30%, right? And so number one is you want to understand what's driving that. Is it the selling price or is it the cost? If it's the cost, kind of let's take a look at the breakout. Is it the labor? Is it the raw materials? Is it the packaging? This is their weakness. And even though up front, you kind of take a look at it, well, gee, this looks terrible. Maybe there's a way then for you to exploit this, right? And you're going to tell them, hey, your margin is terrible. I want a deal on this investment. But that on your end, you'll be able to solve it. it could be a variety of different ways you solve it. Maybe you really do have great production background, or somebody who can come in and restructure that, right? Again, it could be a bunch of different reasons. Maybe the equipment is bad, and with that equipment and production setup, the extraction yields are just terrible. It's like yielding below 10%, but if you bring in and purchase this type of equipment and, you have this chemist working here, it's going to go up to like 13%. And the way I also want you to kind of look at this is kind of really look at it in terms of the dollars and look at it like very, very analytically, right? Kind of go back to the numbers. Hey, if we bring in this guy, we buy this equipment, our yields are going to go from, again, let's say 9 to 14%, and that's going to increase our margin by this percent, let's say 5%, 10%. And now if we scale revenues from 10 to 50 million, that's going to mean our cash flows are a lot higher, right? And so now if we go ahead and sell this business, we're going to get a tremendous valuation for it. And so really kind of taking that analytical approach is going to help in two ways. One, you know what you're kind of walking into. And two, down the road, you'll kind of know, hey, we can, by making these changes, we can increase the valuation by this amount. And when we sell it, we'll have a great ROI on our investment. Some of the other reasons where the margins might be low and the cost to produce might be high is just that the raw materials that business is buying is too expensive, right? And on your end, you might already own a couple of businesses, right? You might already know vendors. And what you can do then is either, you can buy a bulk and get a discount. We just know vendors that will sell you a product that's of the same quality and it will get you the same results, but for a smaller price. And again, this might increase your margin by a couple of percentage points. And again, that's going to translate into better cash flows and better valuation down the road. Another reason might be just that the production runs are set up very inefficiently. So then kind of the cost to produce one unit takes a lot of hours, right? A lot of labor. So on your end, if you kind of come in and you restructure that production, bring your production manager that kind of really knows how to run those production runs and production team, you can cut down on that cost a lot. Another thing you see with a lot of these operations is that the spoilage is rampant. You take a look at it and there's a lot of raw materials that get wasted. And again, this is really making that cost to produce a lot high. Again, in the same way, if you really understand the productions and you can bring your production manager, you guys can work through that, right? You can improve the production techniques and really reduce that spoilage to a small number. And again, every operation should track this. And if you walk into an operation that's not tracking this, that's a reason for you to ask for a discount, really, right? And get a better deal on this investment. Another situation you might run into is that the sales are low, right? And there could be a variety of reasons for that, right? They may have a great facility, right? The equipment is great. The capacity is great. They can run 50, 80 million out of this facility, but they're not. Their ability is to produce things at a great margin, right? So kind of all the ingredients are in place, but you kind of walk in and, wow, why are revenues so low? And really what it is, they just really lack market penetration, right? And so then there's really different ways to tackle that. And you really kind of have to look at your strengths and your connection in the industry, right? So you might have a great distribution network, 300 dispensaries. And, tomorrow you can start getting their product into 300 dispensaries like right away. So that would then be really great synergy. You can buy this company at a deal and within a year, you can, double their revenues or triple them. Or it might be, okay, so maybe you don't have a great distribution network, but you have great experience in running sales and marketing teams, right? So their problem is that they're really running those things inefficiently, right? Their sales commission isn't properly structured, right? So their sales team isn't hustling enough. Maybe their sales maps and districts are off, right? One salesperson is only visiting a couple of dispensaries, whereas they should be visiting a lot more, right? Maybe their sales script is just totally terrible and needs to be worked on, right? Maybe their marketing strategy is just non-existent or just very inefficient, right? They spend too much money on things they shouldn't be spending on and spending too little money on the things they should be spending on, right? So if you really kind of understand those things and you know how to do them, you can walk in and really kind of scale up those revenues. What's kind of fun with these valuations and the projects and acquisitions and investments is that it's kind of function of both things, right? On one hand, you have the science, right? We looked at that model. That's like pure finance math. Like it's heavy, right? Like you change this number and the value changes, right? But that's just one part of the equation, right? The other part, the bigger part is stuff we're talking about now, kind of the qualitative stuff, right? And that's the art, kind of understanding those strengths, understanding the weaknesses. How can you, jump in and change things around? Sometimes as far as kind of improving the low sales, you may know a lot of great brands in the industry that are sick and tired of producing their own thing, or maybe they're just looking to find a manufacturer that can do it for them. And there might be also out-of-state brands, right? So kind of same thing, you can, if you acquire this company, you'll be able over the period of next year bring all these brands onto their manufacturing facility, right? And really kind of ramp up the sales. Another kind of opening you see in the market, right, is that, you have a lot of these, for example, Colorado companies that, they have a developed market there. They know their product works. They know the demographics exactly, right? Hey, we're selling to men from 45 to 56, right? Or, hey, we're selling to women from 32 to 36. They have that data. They know it works, right? But the difficulty for them then is, hey, how do we get our product into California? We don't have the license, right? Or to get the license, it's very costly. And so there's a huge market opportunity there that if you have a manufacturing license in California, you can bring a lot of these brands online, right? Or if you're looking into a company to buy a manufacturing company, that can be a quick and feasible way to really scale your revenues, right? So you can say, hey, over the course of the next year, I'm going to bring all these brands, right, from Colorado, from all these different states. I know they work. Now I just got to take it to California and really take it to the next level. And again, let's just to kind of quickly wrap it up with a couple of takeaways. So one is, evaluate these B2B cannabis operations along the same criteria, right? Because again, they're very similar. They're selling from their business and they're selling to a different business. Two, take a look at their branding, kind of branding versus white label. Take a look at their projections, the breakout of those projections, the costs, the margins. Focus a lot on distressed businesses because, again, there's a lot of great opportunities there. And lastly, look at compliance, licensing, and taxes to make sure all those things are in order before you make that investment decision. And if you need help with any of these things, it's important to really work with a strong team that has a deep accounting and finance expertise, in addition has a deep insight into the cannabis industry. And so if you're really thinking seriously about this and you wanna buy a business, reach out to us. Contact us at our website, www.greengrowthcpas.com, or call us directly at 800-674-9050. Have a great day, and we'll talk to you soon.